Well, good afternoon, investors. Welcome to our Tuesday afternoon bull sessions, our November 14th, 2023 edition. My name is Mark Robertson. I am joined here by Ken Kavula. Good afternoon, sir.
Good afternoon to you, and good afternoon to all of the folks in our audience. We're glad to have you with us. I think Mark is going to regale us with a little bit of braggadocio today. I'll try to come up with the biggest words I can find, okay, to balance out what he's going to talk about in the beginning here. So, Mark, we have to turn it all over to you to entertain us for a while. Go.
Are you not entertained? All right. We also have with us in the background, I don't think Kevin is here, so you're safe with your big words for now, Ken.
All right.
We are also joined by Kim Butcher. And how's the construction going down in Florida, Kim?
Had to get another gallon of paint today. After I get done with the meeting here, I'll go back to painting.
Well, good. Sherwin-Williams, Home Depot, and or Lowe's all need your business right now.
They're getting it.
Good stuff. And did I hear that Matt Spielman has joined us? Good afternoon, Matt.
I am here. Hi,
Oh,
everybody.
there's Matt. Okay, he's back in the back room. Okay, hi, Matt.
He is here.
Yep, I'm not used to letting myself in yet, so I was there before and then came in.
Okay.
Sneaking in the side door. And we are going to touch briefly on the book Same as Ever. I have not read it yet. It looks like Matt has read most of it. And Morgan Housel's latest book is pretty good stuff. We do have a serving of applesauce for everybody at the end. Herb Lemkool asked a question at last night's Mid-Michigan program, and we'll take care of that here in a few minutes. We are going to talk a little bit about Uber Technologies, and going to celebrate stock selection a little bit. And yes, there is a little bit of celebratory-esque stuff. The rumors are true. I did come home with the trophy for the Mid-Michigan Stock Pickers contest, so I am this. I was tempted to put a blind squirrel on the cover page, but I didn't feel that was enough celebration. So you guys know the drill. Here we go.
There you go. Congratulations, Mark.
Internet cyber standing ovation. Good stuff. All right, here's your weekly reminder that Portillo's is not a sponsor of this session, but they should be. All right, here's the standard boilerplate disclaimer. No investment recommendation is intended. This is all about education. Everything that we do here is centered on what we have learned and love to share as far as the lessons learned, the methods, philosophies, techniques, analysis, all that stuff with the modern investment club movement, as we have interpreted it at Manifest Investing in our work with the National Association of Investors or Better Investing. So you're going to hear opinions, interpretations. You must do your own homework before making any decision. We will talk about companies that we own sometimes, and we try to remember to disclose that. We do a monthly program called the Roundtable. It is generally the last Tuesday in every month, 8:30 Eastern Time. We have had to shuffle around a few dates for the next 6 months, so we'll be out with those here shortly. But if you'd like to be added to a reminder list about that monthly program where 3 or 4 or 5 of us get together and share an idea, send an email to nkavula1@comcast.net. If you'd like copies of these slides, or if you have any questions or suggestions for future topics, our 2 email addresses are right there. markr@manifestinvesting.com, kkavula1@comcast.net. Anything you want to add, Ken?
No, you did a fine job, Mark. Okay.
All right, here's a little variety for us. Here is that value line arithmetic index. We're looking at a little over 10-year period here. These are monthly bars. So these are monthly bars. And you can see that little bit of a kind of a rolling recession we had back in 2016-ish. And you can see the impact of COVID in 2020. And you can see the flat spot and the bit of a decline that we have recently experienced. Now, one of the things we do like to point out, we have talked about this in a number of different places as far as the relative strength index. And I think this one shows it pretty well, Ken. You have 3 places here where the relative strength index got into an oversold or a red hot type condition. There's one here, there's one here, and there's one here. Each one of those now this isn't always going to happen, but each one of those was followed either by a decline or a flat spot. And it's just something to be aware of as you're thinking about the relative strength index. And this shows it to you in group fashion. And we look at these also for individual stocks. The one thing I would draw your attention to, this is a monthly chart from Stock Charts. I don't think you can get that in the free access to the site. I am a subscriber. And whenever I do this, I switch the look back period on the relative strength index to a trailing 12-month period. So this is really a long-term look at this type of chart, this type of indicator, and something that you would very rarely ever see a trader do. So.
And just to be fair, Mark, that one in the middle there with the 2 humps attached to it, while that first big hump there right there before your red slash might have been a selling opportunity, notice that it did go down slightly and then went back up and surpassed the first one. So this is not anything exact, but this is something that just kind of helps you out a little bit and maybe ends up as a great tiebreaker if you're deciding, if you're on the fence about when to sell or when to buy. The RSI is just one more piece of information. I guess what I'm doing is I'm warning you against using this as anything automatic. I don't think any indicator that we talk about ever is an automatic indicator, and you have to use your brain and you have to think a little bit ahead. And sometimes the best laid plans, ... you know how it goes. So don't take this as, it hit 70, I have to sell, or it hit 30, it went below 30, I got to buy. It just doesn't say that.
Oh yeah, not even close. And in fact, another thing that we love to point out is that sometimes a stock can stay overbought for a very long time, multiple years. And that's something to be considered.
And anything Mark says about overbought is equally true about oversold.
Yep.
You can find stocks that languish with an RSI down in the 20s for long periods of time, which means that this is not anything precise, and you usually have a little bit of time to make some decisions. And again, it's one piece of information. It's not something that you want to use as anything that like a trigger. It's not a trigger.
Yeah, and the one last thing that we'll point out, back during the pandemic, this point right here is actually pretty special. It actually aligns with this down here, and a relative strength index down at 30 or below on something as aggregated and big. It's a composite as the value line arithmetic average. It really did suggest that you should be out there studying and carefully seeking opportunity in that situation. We're kind of in one of those modes right now where many of the pundits on TV would like to make you believe that everything is over, basically not on sale. And I think things are closer to being attractive than they give it credit for sometimes. We're right in the middle of the range. We've been in a flat spot for quite a period here, if you really think of it as that, a couple of years. And again, things are just not as bad as they sometimes make it on TV. All right.
Our friend Mr. Douglas has informed me that with the free stockcharts.com, you can get daily and weekly reports, but you can't generate these monthly reports. So if you're looking for a monthly report, you're going to have to wait for Mark to generate one and show it on a screen occasionally. But you can go in and get daily reports, and you can stretch them out for long periods of time, and you can get weekly reports. They'll look a little bit different, but they'll give you the same general kinds of information as Mark's graph does.
Absolutely.
Might be a little bit more wiggly. Let's put
Thanks.
it. That's a
Yeah,
use a technical
definitely.
term. Okay.
Little wagging going on. Okay, here's an
Yeah.
update on our contest, the Groundhog Challenge. We do have a new leader. It's Virginia Williams from Atlanta, and she's just barely pulled ahead of Ann Renly. And not much change, except at the top of the list, there was some pretty hefty shuffling, including Einhorn moving down and Buffett dropping down a little bit. So Ken, you're right on their heels.
I've got that's as high as I've been. I'm very pleased with that. 14 is a great number, and I continue to marvel at Herb Lemkool and his minions. Herb Lemkool's on the list at number 9. One of his associated clubs is on the list at number 3, and another one of his associated clubs, I saw it on here, didn't I? Yes, at number 30. So 3 clubs in the top 40. Kudos, hoorah, hoorah, hoorah to Mr. Lemkool and his minions. Okay.
That's actually much more significant than one individual winning one contest in 21 years.
Especially since we see these 3 names on a lot of the tops of our groundhog lists over the years, Mark. It's not a one-time phenomena. So Herb deserves all the credit he can muster when he's able to help his groups do what they do.
More on Herb in a few minutes. The Wilshire 5000 continues to crank in at about 4.7. Again, this difference is historically huge, basically saying that the medium and small cap companies have really failed to keep up in a big way. So Ginger's pretty well loaded up with some technology up there at the top and pretty well positioned. It is interesting to see Go ahead, Ken.
I haven't made the point for a month or so, and I'm going to make the point again that I think one of the issues that we have with the new value line arithmetic average, and it's not a new average by any means, but I think that there have been coming to market so many companies that don't make anything as far as earnings are concerned. I was doing industry study kinds of perusals down different lists of different industries, and I was looking at information technology services and medical devices this morning, and I was just amazed at the numbers of companies in both those industries that make absolutely no earnings of any kind and haven't had earnings for 5, 6, 7, 8 years. And yet here they are included in a lot of these small company indexes because they have really great lines of sales, or they might have 2 years of increasing sales. Again, I'll use one of my favorite quotes. They're priced to hope, not priced to earnings. And I think that's one of the reasons why you see this value line arithmetic average moving in the direction it's moving right now. People just aren't buying companies that don't have earnings. I think we learned a lesson, and 6 or 8 or 10 months ago, those companies started to crater, and I don't think they've begun to recover yet.
Yeah, it's a fair criticism. It used to be, at least in my experience, pretty much reserved for the early stage biotech companies. You'd be looking at one of those on a value line page, and you'd see all those D's for deficit. Everything was negative, but it has been permeated by especially some of the technology companies. We're going to be taking a look at Uber here in a few minutes, and that they're guilty of that a few years ago, for sure.
Yeah.
Or actually a few quarters ago. All right. Pressing on. Yeah, we will celebrate a little bit. Ken and I had a little bit of fun last night with the Mid-Michigan chapter, and it's a fun contest. It's a bunch of investment clubs, and Ken actually tolerates individual entries. And I have finished fairly well in the past a few times, but it's been a while since I finished up near the top. I just want to say thank you, Ken, because I know as the scorekeeper, you could have probably messed me up.
It's not hard to do, but I try to keep it as honest as I possibly can. So.
I have been accused of allegedly, being the scorekeeper in the past, so we'll see. Here's a look at the participants in the contest, and really kind of fascinating. Again, some of these names, Porta Value, Synergy, B.I. Baker, Cool Kids. I think Big Rapids is new to us because of their geography, but all of these clubs are on the leaderboard pretty consistently over the years. So good stuff.
Mark, is your top entry of Mark's Manifest, is that the original club?
Not my original club. No, that's just an individual entry. I am
Okay.
apparently not eligible for prize money, and the trophy is a phantom trophy. So good, clean fun. Here are the 5 stocks that I picked. And by the way, I probably felt the strongest about Generac among the 5, but Ardelyx did help.
Good instincts, Mark.
But I got to say, Ken, this was actually a more measured, with the exception of Ardelyx. The group of companies was actually pretty tame for me.
Well, and I will tell you, Mark, when I got your entry a year ago, I actually recognized all 5 stocks, and that's something I usually am not able to do with your entries. Okay, we're getting a question from Nick in the audience, and Nick wants to know, can he view this this presentation that we did last night? We spent about 15 minutes presenting prizes, and then we moved into a class that talked about a lot of things near and dear to Mark and I as investors, and gave people a lot of ideas for finding ideas. And you can find that recording on the YouTube channel. And the name of our channel is Manifest Investing Roundtable. And you can Google Roundtable, you can Google Manifest Investing, you can Google Mid-Michigan Presentations, and any of those things will take you to that channel.
Yeah, search on YouTube and you'll find it under Manifest Investing.
Right. So it's there, and I don't know if Mark got a chance to post it this morning, but it will be posted soon. If it's not, it's already posted. So there you go.
It's already among the leaders for the most favorite, and people are loving it. And
okay, well, I'll tell you, folks, if you haven't subscribed to the channel, please subscribe. Help us out. We're over 1,000 now, and we're shooting now for 2,000. So just press the button and subscribe and help us out. We don't ask you for a nickel, so give us a press of a button if you possibly can. Here's the clubs in order, and I don't know if you know the geography from Michigan, but these top 7 clubs represent the entire outstate area. Our chapter does not include Metro Detroit. That's about 5 counties down around the Detroit area. But all the rest of the state of Michigan is now mid-Michigan. And these winners, these top 7 clubs, are from all over our area. So we're very, very pleased. We visit a lot of these clubs. We keep in very close touch with a lot of these people. And we're so happy when they're able to put together a portfolio that gives performance. You can see the performance that they've gotten. They started with $100,000 on November 1st. And by October 31st of this year, it had grown in Mark's portfolio to $141,500. The winner of the contest, the Big Rapids Investment Club, a 40% gain over the year. And that's certainly not usual or regular for most individual investors, for that matter, for most club investors. We're just very pleased with it.
Yeah, these numbers are refreshing. I mean, considering what we've had the last several months, to still come in this strong, and these were through the end of October, into the first day of November. So good stuff. The other thing I wanted to point out, and I find this really kind of cool, is the Your Choice portfolio that doesn't have a rank. It doesn't have a rank for a number. This is the consensus selections made by all of the clubs. And what is absolutely fascinating is it almost won. If you think about what hidden meaning is there behind that, that is so cool. Here's a look at some of the companies that are in that particular portfolio. Had plenty of the The Magnificent Seven, we'll talk about that in a minute, but Apple, Align Technology, Advanced Micro, Amazon, Access Financial, Costco, Google, Lululemon, which actually dropped off a little bit at the end but had a great year, Monolithic Power, Microsoft, NVIDIA, Tesla. I mean, these are all pretty formidable companies over the last year, and really interesting to see them come up as consensus selections from this group of, high performing investors historically. So very cool to see that happen, Ken.
We're going to start our new contest for those folks that are at the bull session that have a club based in mid-Michigan. We're going to start our new contest on April Fool's Day, April 1 of 2024. We're trying to move the end of the contest so that we can follow it up sometime in the spring when our roads are not snow clogged and when people aren't out hunting deer. So we'll make sure we get lots of information out about the contest. And if you're from outside mid-Michigan, I just don't have the time to process more than 35, 40 entries. And we appreciate your interest, but this contest is only for clubs that are based in our chapter.
Okay. Ken spent a moment with the Magnificent Seven last night. Again, just making the point, we've talked about this a few times at bull sessions over the last couple months. Speaks for itself. I mean, those are the companies that have accounted for much of the gain in the market over the last year, and they are heavily weighted in the S&P 500 and the mega cap type ETFs that are out there.
And the reason I chose these 3 points from the Motley Fool website, Mark, was that I just am incredulous when I read all about this and I know what I know about stocks and I watch the SSGs that are behind this, the business models that are behind this, and then I see this fact that all 7 of these stocks have buy ratings right now. I certainly don't think that I could do 7 reasonable stock selection guys that would show me buys on all 7 of these companies, and yet the analyst community are telling us one thing on TV. They're saying these are not going to be good investments into the future because they're way overvalued. That's what you hear consistently on TV, and yet in their own offices they're telling their clients to buy these things and to keep on buying them. So they're great companies. I own a lot of them. I know Mark owns some of them, but I just don't think they're all buys.
Yeah, and so as we promised last night, here's a look at the 7. And just to kind of give it a little more context, I mean, these are the projected annual returns. Now, some of them look pretty good, but there are a couple there that are a little bit towards the market average right now. I would be more influenced by the approved number for these, and those are all, fairly ordinary, nothing spectacular type numbers. Keep in mind that Facebook is coming back from being cut in half, actually cut in more than half, not that long ago. So kind of an interesting situation. The other thing I did want to point out, this is a question we often get from audiences, and they'll ask us, well, why are the manifest numbers so different than Value Line? We just had it in New Orleans. What I'd like you to take a look at here's these 7 companies, and these are the 7 Value Line low total return forecasts. So those are very, dare I say, dreary, Ken. Those are the low forecasts, but the median forecast will be just a couple percentage points above that.
Yeah, with the exception of Google, the numbers are not that interesting. And when you compare those to the Morningstar price to fair value, you're looking at a group of stocks that Morningstar at least feels are just pretty fair value. They're not overvalued by that much. Google the most at 123%, but I just don't think we put a buy next to a fairly valued company very often.
Yeah, by our standards, only Alphabet or Google would meet that criteria. By the same token, and this is important, the analyst consensus, in other words, everybody but or including Morningstar and Value Line is right here. Some of these are staggeringly in disagreement or dissension. I mean, the analysts think Tesla's a screaming buy right now. And they feel pretty much the same way about NVIDIA. And these are all buys, by the analyst consensus numbers. So again, we factor all of these into the aggregate work that we do at Manifest, but this might give some explanation as to why our numbers would be a bit different when you see those different flavors. The other thing I found kind of interesting is I left the 23 over 22 and 24 over 23 sales on here because some of those are fairly interesting to look at too. NVIDIA continuing to grow at a very high rate.
Well, and you go back to the RSI point you were making earlier, Mark, the whole group is closer to 70 than it is to 30.
Yeah.
So
again, different opinions make a market. The top 5 are all roundtable companies in the current version of the roundtable, and Google and Amazon are in that long-term portfolio we put together not too long ago. But again, different opinions, just be aware of them out there and dig in. It's kind of fascinating to see that big of a difference for a company like Tesla. All right. So with that, I thought we would spend just a few moments with Uber. Seems how Ken and I spent time with Uber in New Orleans. And was that the first time in a while you'd actually
that was, except for one time about 6 or 8 years ago, Mark, that was the first time I had done any real Uber dealings, and I was very, very pleasantly surprised, number one, with how easy the process was, and number two, with how polite and professional the drivers were. It was a joy to take the ride, and I thought it was very reasonable priced for the service you were getting.
Yeah, the pricing actually kind of surprised me. The reason I bring these guys up, though, is, the question that I heard fairly recently is, what might be a contender for the next one of these Magnificent Seven companies? A company that really latches on to a consumer need and addresses it well, that sort of thing. And Uber keeps coming up in these type of discussions. It's kind of hot on Wall Street right now, which isn't necessarily a great sign, but they are under fairly new management. Lots of good stuff happening. The cell phone completely enables what they do. They have streamlined that aspect of the business. I mean, you can watch the driver approaching you, and it really is kind of a pleasant experience for those of you that have not actually tried it. It's a modern day high technology taxi is what it comes down to, and really quite effective. Here's a look at the value line, the top of the value line page, and you can see there is a limited history here. One of the points that I think can be made about what we see happening right now is that we're within striking distance of the IPO price. You see the IPO price listed over here. We're actually fairly close to that right now. And the question, and this is what we were just talking about, Ken, these D's give you the heebie-jeebies, don't they?
Yeah, they do, but I just have a really difficult time looking at a company that doesn't earn anything, and I understand that companies have to go through this at various times. I've watched companies that I've owned go through this at various times, but I've never really been invested to any great degree in companies that continuously lose money. And here's one losing money 3 out of the last 4 years. I'm sorry, 4 out of the last 4 years. I was reading the cash flow.
I thought maybe you're loaning them 30 cents to get them in the black.
I wasn't going to do that. I do notice that 23, 24, and the 26, 28 forecast are positive, and that's really something that it kind of tickles my fancy. But at the same time, this would never be something that I would put a large amount of money in. This would be part of my, I shared with our audience in Louisiana that I have 10% of my total portfolios that we play with a little bit. And this certainly would be money that we played with, not anything significant. It's not going to take up a big part of my nest egg, especially at my age. And yet I really, really appreciated the service itself, Mark.
Mm-hmm. Well, I do think they're kind of coming together. We'll talk a little bit more about that, and nothing is guaranteed. The one thing that I would point out, we have cautioned people that if you do dabble in a non-core slash speculative type investment like this, and this happens now, I mean, the 2020 thing was COVID related, and they just got hammered, but they almost went positive, and then they went back negative. This is what happens to the stock price when that happens, because it scares the bejesus out of a whole bunch of people. And so when they go back negative, again, many experts thought this company may have disappeared from the planet during the pandemic, and they very nearly did. The only thing that saved them during the pandemic, because people stopped moving around, was the addition of Uber Eats, which is the delivery of a food service. And then fairly recently, they've addressed a number of challenges with their workforce, and they are now beginning to do a little bit more targeted advertising. So there are some interesting potentials here. Here's a look at the recent stock price, along with a little bit of narrative from, I don't remember the exact source of that. Oh, it was, well, Finance Yahoo. We'll cover it there on the lower left. Digging a little bit deeper there. But they have shot up a little bit on this perhaps expectation that they have finally arrived at the so-called launch pad. And again, this mobility is still a lot of stuff. They're doing pretty well with the driving services, but the delivery is doing well. And there's a lot of potential in targeted advertising. Like if they're taking you to the airport and you've got an alternative to American Airlines, maybe they've got some advertising to help you out there. Anyhow, they are turning positive on their profitability. So something to think about. Here's a look at the other major factors here. Again, that top line is the thing that Ken said he finds compelling. It is a 20% growth rate, left to right. They do have fairly new leadership. He's been there a few years now and has fixed a number of core issues. And they are beginning to have earnings. Now, Value Line is in with a fairly negative outlook for the long-term forecast. It's much different than what you see here from the analyst consensus. Just something to be aware of. Any thoughts on that, Ken?
Well, I think I've said it all. It might be something that I would play around with in the non-core part of my portfolio. And Mark, you might be absolutely spot on that 12 years from now, this will be another Microsoft or Apple or any of the other big players. But right now, I just can't stomach touching it with anything other than a very few dollars from my speculative part of my portfolio.
Mm-hmm. Makes sense, because here's the question. Where do these guys end up? You know, with respect to the operating margin, which is always going to be more positive than the bottom line net margin. I mean, we're looking at numbers here of around 10% for the bottom line. Where does this end up? You know, and does it, you know, what can we compare it to? You know, a mature FedEx, mature restaurant industry, some blend of the two. It's a tough question. And
isn't part of the problem that we're dealing with a complete disruptor? I mean, this business model came along, and there were a lot of folks that couldn't even get their arms around what the heck it was doing. You know, this what do you mean ride share? What do you mean you're not really hiring these people? You're kind of employing them, but you're not really employing them. How does that work? And you're doing it all on your phone? You know, all that kind of stuff. All those questions came into play. And I think it was a mistake as well to offer these services for an extreme discount in the beginning, and then to have to raise prices and drive people away that were expecting that extreme discount to be the norm going forward.
Yeah, and they seem to have addressed that, based on what we witnessed in New Orleans. Those prices were not unusual, and they seemed pretty palatable from where I was sitting, anyhow.
My
So
sister lives about 15 miles from the Detroit airport, Mark, and 4 years ago she was able to Uber to the Detroit airport for somewhere between $18 and $22. Today she does the same Uber drive, same house that she's living in, same airport, and she's now paying somewhere between $55 and $60 for the same trip.
interesting.
That's not normal inflation. That's a seismic jump in price, and I think it has to do from the fact that they're no longer doing deep discounting. They're asking for a fair price for the service that you're getting, and it's still cheaper than hiring a limo. It's still cheaper than taking a taxi. It's still cheaper than doing a lot of other options. Especially if you're going to be gone for a long time, it's still cheaper than parking your car in a lot at the airport or near the airport. So there's a lot of things going for it, but it's not dirt cheap anymore, like some people had come to expect.
Sure. Your sister's probably riding in the deluxe version, whatever they call it.
No, I know she's not.
I know she's not.
I'd add too, looking at the future, guys, right? So Uber always had in mind too that it would be driverless, and until the end of 2020, had its own arm to develop that and sold that off because they needed money. But I would say kind of like Tesla, until we agree Tesla's profitable now. It's a profitable automaker. Who knows where it'll go? But it went through no less than 3 near bankruptcy experiences, the last of which being the launch of the Model 3. And you think, the Model 3 was somewhere down the line for them, but they were still betting the farm on that. And I think Uber still has a bet the farm moment coming on at the point where autonomy is scaled to the point whenever they choose to, I'll say, really introduce that or make that a core item, they have their drivers who might not be excited about that. And just like traditional taxi services weren't excited about Uber coming in, they've got another sort of internal change where they have to kind of kill themselves off or find a way to coexist, which is a very dangerous point for the life cycle of a company, that they have to decide to be here and there. You can think of Kodak, which invented digital photography and was killed by digital photography. You can think a lot of things like that, where they still have one big bridge to cross at least before they're probably in the originally imagined end state.
That's a great point. I mean, one of the things I've always wondered about is, how did Fuji survive? What did they do differently? And it might be an interesting thing to air out here at some point in the future also.
I'll give you another name to put up there with Kodak. Put Xerox up there with Kodak as well.
Sure.
Yep. We have a hand in the air. It's our friend Herb from Traverse City. Herb, go on. You're unmuted.
Yeah, I just wanted to make a comment that the medallions for taxi cabs in New York City became almost in the toilet because of the Uber program that started.
No, definitely huge impact on the New York transit market for sure.
Yeah, that became a point, and I forget who it was. It used to just be Medallion Bank, but that was one micro story in the bank issues in March.
Bank of New York.
Other underlying assets, they went down.
Bank of New York, Matt.
Yeah.
All right, here's a look at current analyst expectations for the company. You can see again with that longer term outlook, Value Line has a pretty not robust long-term forecast, whereas Morningstar is checking in at a fairly decent number, and the analyst consensus is slightly on sale also. You can see their estimates for sales and earnings over here. All right, so again, this is what we're talking about. This is the area that gives many of us heartburn, but at the same time, if you can find a situation which can latch in and basically reach that launch pad moment, which is right here, and continue on that course, Matt has brought up a wonderful threat to the shape of that curve. well, maybe not wonderful in the eyes of Uber, but it's a legitimate threat. And we covered this back almost 2 years ago with the talk about this early stage nature of investing. Again, most of what we do, that is not to scale. The core arrow actually for most companies is much bigger than the non-core arrow, but we do like to find them as early as is reasonably possible, but also hold them through a very nice mature growth and maturity area. Again, holding a company for as long as it makes sense to do so. So,
And we did make the point, Mark, when we did this a while ago, that not all companies go into stage 5. There are many companies that we can point to that continue to reinvent themselves with different products, with different ways of doing things, with disruptive technology, and they continue to keep that upward moving line in the stage 4. They continue for that line to keep going. And that's the kind of company, in fact, that we would love to be able to find and hold on to for 20, 25, 30 years.
yeah, the examples are all over the place. Intel, of course, is very famous. You could make the case that when McDonald's added breakfast and the coffee, that they actually staved off some of that flattening in number 4 there. But yeah.
Or Microsoft, which blew the mobile phone, and so it tried and fell off, and then came back with cloud computing entirely different.
That's exactly what I was going to say. That Microsoft has probably reinvented itself maybe 3 different times. I mean, remember where it started? It was nothing more than a system software producing company. I mean, think DOS, think DOS. There it was to begin with, and it's a lot more than that today.
Now, I'll tell you the other one I find fascinating, and you guys have both put this on the round table, is Adobe. You know.
Yeah, well, you got it right.
Yeah, good stuff.
And what's so decent about Adobe, Mark, is that it's made itself indispensable. It has widened its moat to the point where I don't think anybody can even think of challenging it in most of the areas that involve documentation, that involve services to trade information and things like that. It's amazing how the company has maneuvered itself into a position that I consider almost invulnerable. It's a great stock, and it deserves every point of PE that it carries, I think.
Yeah, so again, just to reinforce the point, Kevin and the gang at the DC Metro chapter out on the East Coast, they spend some time on a number of their studies trying to identify where the companies they're studying are on this picture. And I think it's a worthwhile thing to do. We key off of the sales growth forecast quite a bit for this, and just something to keep in mind. And again, the inspiration for us goes all the way back to the St. Louis Broad Assets Investment Club, and they were the 3-time winners of our Groundhog Challenge because they specialized and focused on trying to identify a couple of these potential companies for their Groundhog portfolios and managed to win several years in a row, or 3 out of the 4 years. So it's a legitimate thing to seek.
Mark, I'll remind the audience that in our list of 20 of small companies that we chose this year, we tried to stick with business models where they had 4 or 5 or 6 years of consistent growth in sales and in earnings, but we did make a couple of exceptions. If you're looking for a company that might be right where that light tan arrow is pointing right now, right at the place between section 2 and section 3, just moving into revenue, moving into profitability, look at the chart for Shockwave Medical. It's just barely begun to move into profitability, and it certainly has moved quite assertively into profitability in the last, I don't know, 2, 3, 4 quarters, something like that.
Yeah, very promising company and technology that
Yep.
definitely fits that description. So we'll be watching that one and cheering them on this year. They did take quite a hit recently, but we're not allowed to look at that on a weekly basis anymore, Ken.
Right, I know.
All right, so just kind of closing things down, the company has kind of reinvented itself. They are facing all kinds of issues going forward, but again, the combination of the business model segments is pretty good right now, and I don't know. I may take a flyer on just a tiny sampling of it just to stay in touch. Okay.
Mark, did you find it interesting when two of our drivers indicated that they'd rather make short trips all day long than to make long trips that cost people more dollars? Did you find that interesting at the very least?
Oh, absolutely. I mean, if it really catches on and they can do those short runs, they can have, 3 or 4 trips in an hour, and they do much better than, braving some of that inner city traffic and all that sort of thing. So.
Well, and I think the percentage tip is a lot higher. If you're only paying $8 or $9 for the ride, I think you might end up tipping $3, $4, $5 on top of that, so that the percentage tip that you're giving over the hour, if you can do 3 of those or 4 of those, is probably more than you would get for a long drive.
Yep.
Just an anecdote, you guys, not to rub in your own experience. The longest Uber drive ever taken was kind of a publicity stunt by a YouTuber named Mr. Beast. The second longest Uber was 680 miles from Dallas to Nashville in 2018, taken because they missed their flight. The driver estimated his cut of that would have been $800.
We should have considered just Ubering home from New Orleans.
Man, it never occurred to me. Anyhow, the other thing that I just wanted to leave on this slide, this company does not have a PE yet. This is basically an artificial number. It's a pick out of the air, so that makes this number a little bit suspect. This, however, is the type of number we talked about during the discussions on Amazon and Tesla and companies like that. That's something you can sink your teeth into by looking at the capital structure of the company, and it's borderline attractive. It was much better at $40 than in the mid 50s.
And that 8% proof might be kind of whispering that the 45 should maybe be 40 or even 38, It's
exactly how we look at it, and maybe 35 or 30.
Yeah.
So, yeah, that sort of thing. It's definitely coming into a maturity. All right. Quick reminder that we do archive all of these sessions on YouTube, and last night's Mid-Michigan session is on the YouTube page. Please subscribe and we'll let you know whenever we add new content. This is something I don't know how we could avoid taking a closer look at the book. Did you finish it yet, Matt?
No, I blazed through a quarter of it in a day, and then I had a busy weekend, so I'm halfway through. I've finished the front 9.
Well, these are some of the highlights that Matt encountered in his first session with the book, and it just screams of wanting to spend more time with, including Ken. He's even got your 15% number in here, or +5.
Yeah, and those who don't know, Chamath is Mr. SPAC. Imagine a venture capitalist pining for our sort of investing, and think about the irony. And it is a very digestible book. It's 23 chapters and 240 pages, so it's the kind of book you can have 15 minutes or 30 minutes with it, and finish a thought. If you're in a waiting room or just have a little time, you can get through it and have time to contemplate in between. I've definitely put it down and thought in between quite a bit. Unfortunately, Morgan doesn't narrate the audiobook, so I think he would be an entertaining reader, but didn't have that worked out. To me, it's the third one here is probably the biggest point I've taken away so far. And there's tons of anecdotes. There's market anecdotes. There's anecdotes from outside investing. But to me, this idea that markets should or will not only follow the rules we know, not only follow momentum and price, but go beyond that even somehow, as normal or as expected to happen. It's kind of interesting. And this, Morgan never calls it that, but to me, this is his definition of price discovery. If you know your microeconomics and you have the supply line and the demand line and wherever they meet, that's the price. That looks and sounds very, very clinical, very, very calculated. But I just had the mental image earlier today that this really should be next to a picture of a commodities trading pit, right? Everyone's shouting, and some people have anguish looks on their faces. Some people are happy, right? It's a crazy mixed up thing with every kind of investing you can think of, right? All of the Wall Street bets guys are in there. All the algorithmic traders. When we were trading around in Western Alliance in March, I couldn't believe how long my trade confirmations were, because they were being fulfilled 1 or 2 shares at a time.
Wow.
I'm thinking that, this is some guy on a phone on the other side of the trade with me, and that is what we should expect at times, despite all of the indicators we have.
Yeah, I do think we sometimes forget that it is still an auction, and humans are involved, so psychology is part of it. Yeah, it can be madness, and Ken's blaming the madness of the auction for some of what's happened to his regional banks, and he's right. Only time will tell how right.
So that's the most actionable point. Probably the biggest mind blowing is the second point of Jeff Bezos. I can't imagine being a newly minted director, walking up to talk to Jeff Bezos in 2004 and having a presentation on what isn't going to change in Amazon. You'd think that not only would you be kicked out, but so would your 2 bosses above you. But to think of that guy who's at the center of so many big changes, to be thinking along these same lines as that's the difficult question was really interesting thought.
Good stuff. So you can expect that we'll be spending some time with that in the not too distant future.
Mark, the professional teacher in me would like to nudge you just a little bit and remind our audience when we first encountered Morgan Housel.
Well, I encountered him years ago, actually at the Motley Fool during a visit. But what are your thoughts?
I'd like to tie him back to what we've been doing in bull sessions here. I think I probably know, but I think that's important that we give him a little bit of grounding in what we've already dealt with this gentleman and what we've already read from him and what we've already gleaned. What's his background? What's his reputation? What do we like about this gentleman?
Well, he's a columnist. He's a money manager, and specifically, what we dealt with is the book that's listed at the bottom of this one as his previous book called The Psychology of Money, and many of us read that and think pretty highly of the way he frames.
So this was the gentleman we talked about when we talked about Annie Duke, right?
That was Joel Tillinghast, but we did the Psychology of Money just before those 2.
Mm-hmm. And I'm sure he did come up a little bit at that time, for sure, because of the psychology aspect of it. Yeah,
they're very alike. I've not heard Annie or Joel cited yet, but I'm only halfway through.
So he's not new to us. We've already discovered this guy, and I'm just encouraging folks to grab the book and read it, if not for no other reason than Matt has found it interesting, and Matt's usually pretty spot on when it comes to reading about investing. So take the time. I'm going to buy the book or maybe download the book from my library if they have it and see what I can do with it.
Yeah, I do wish he had done the narration of the book, the audio version of the book, because I think that would have been special. But
no, he does. He does have a few podcast interviews out there. I've actually not seen The Fool. But there are a few podcast interviews too. If you want to get some ideas of the big points beforehand, there are there's spoilers in there. It's not fiction, but they do, of course, talk about points. But if you want a 30-minute bite of Morgan, just search Morgan Housel interview and look for a recent podcast. There's a few of them.
Cool. Thanks, Matt. All right.
Good stuff.
Close with our 2 slides. Did you have something else, Ken?
No, I'm happy where we are right now, Mark.
Yeah, we're going to close with 2 slides. We used this also last night. It's just a quick update. Many of you are are familiar with this. If you're not familiar, the Roundtable, we've been meeting since 2010. It's a monthly gathering. We've made 775 nominations or selections since 2010. Every time we make a decision, we put $1,000 into that idea and then keep track of the performance of the portfolio. We did find that 278 actually had current values less than 1,000. And when you add up the loss of those 278 positions, you end up with approximately $73,000. And again, we just keep making the point that the gains alone from our 5-time selection of Microsoft, the gains from Microsoft actually stand at 74,000. It's probably bigger than that today. So these numbers are probably farther apart today with the strength in the market. And that's just pretty phenomenal. And again, it just nudges the question, what are we afraid of? When you think about what the implications of this reality. And we just continue to encourage people to think about that, share it with the people around you who invest, including your club partners.
I had an online discussion, Mark, with one of our attendees from last evening who wanted to know why we were getting so excited about $1,000 of gain over loss. And I had to draw the conclusion for that person that this is only the gain from a single one of the stocks that are positive. And that means that all of the other positive stocks, all of their gain can be added together. And that's what gives us the 14.8% rate of return since the beginning. It's Microsoft balancing out all the losses, and then we can look in a lump at all the rest of the gain. And that's coming from 100 or more different decisions, and that's just a shot in the dark, that number. But it's certainly a lot of selections that are in the positive, including the ones on the next slide.
Yep. And the next slide is dedicated to Herb Lemkool. He asked the question about Apple, and it's a tiny bit uncomfortable question if I put it bluntly. I mean, Herb basically asked the question, what if we looked at the Apple positions we sold and hadn't sold them? How would that compare to that Microsoft number? So what you're looking at here, first of all, there is one active position. I put Apple back in the portfolio a year ago, and it's actually done pretty well. The $1,000 has grown to $1,330, beating the market significantly over the last year. But we did have 8 previous positions in Apple. You can see that a number of people put it in the portfolio. The dates of purchase date all the way back. Ken, you were the first, back in May 2011. And we actually did decide to sell all 8 positions in May 2020 that you can see here. So if we went back and said, well, what if we didn't do that? What if we just left all those open? This would be the current value of those 9 positions. And Herb, you're right. Basically, that would check in at about $84,000 just from Apple positions alone. I'll turn it over to Ken in a second, but what this does nudge me to at least think about is that Nicholson admonition or encouragement that if you're holding a company in your portfolio that has double-digit growth, high-quality company, considered a core holding, you want to be very, reluctant to actually sell that position, because the Apple has gone from 78. And I'm sure we sold it at a fairly rational point in time, but it's gone from 78 to 187 since the date that we sold it. So, Ken, your thoughts?
Well, my thoughts are that, first of all, Nicholson's admonition probably was something we should have listened to when we did the selling in 2020. But I'm not so sure that Apple is that same kind of stock today. I do know that the sales rate for the company, projected at least, is not in double digits anymore. And I want the audience to remember that during this entire experiment with the Roundtable, we've been experimenting with various guidelines for selling, which might work to help keep us out of trouble and help keep us from losing large amounts of capital. I'm beginning to come to the opinion that I need to concentrate more on my winners than I do on my losers. And that slide before this one, that Microsoft slide, or this Apple illustration, I guess I'll call it, both of them tell me that if I don't worry too much about my losers and focus on some of my stocks that are really doing well, maybe, just maybe, I don't have to have more than a single home run to offset everything that's happening. My only regret is that in May of 2011, when I first chose Apple, I didn't follow it up for the next 2 or 3 years with some more choices of Apple, because I think in reality that 2011 purchase generated 14% relative return through 2020. It probably would have done a heck of a lot better through 2023. And again, maybe focusing on my losers is one of the worst things I can do to manage a portfolio. Maybe focusing on the winners and deciding that I don't necessarily need to trigger a sale at any particular point for a high growth core stock, no matter what the par value might say. That's revolutionary for me, Mark.
Yeah, and again, this is 2020 hindsight, so we want to be careful. We can point to a number of situations where the disciplines you just described kept us from getting killed by a lower quality stock. So, we've actually shown about a 4 percentage point advantage to strategically selling versus buying and holding, or buying and forgetting. So, the selling discipline is real. The thing in question here is it's a core company. It's double-digit growth. Should that make it really tough to sell? And the answer to that probably should be yes. And maybe we live and learn. But Herb, hopefully that answers your question. You get 10 demerits for asking it, but just kidding. Just kidding. You know better. You know better. So good stuff. It really is a powerful reminder. And these numbers are absolutely huge. When you look at those are the actual annualized returns. Just absolutely huge. Okay.
We have Joe out in the audience just suggesting that NVIDIA stock right now might be one of those kind of stocks that we're looking at and trying to figure out what to do with a stock that has taken up maybe in some portfolios 25 or 30 or 35% of the portfolio. What do you do with it? Do you sell part of it? Do you hold on to it? How do you come to conclusions about some of these ones that are generally wiping out all of your losses in your portfolio? I also have a hand in the air. Oh, it's Herb again. Go on, Herb.
Yeah, I just wanted to say thank you. This is one of the discussions that a lot of clubs are going to have in a lot of their different stocks, and you guys have done just an outstanding job in presenting this, and I really appreciate the information.
Yeah, and the point I would make, Warren Buffett's Berkshire Hathaway is now 50% Apple, and we encountered a club in New Orleans that had approximately the Apple was 50% of total assets. And again, I think
at least 50%. Yeah. Mm-hmm.
Yeah, and I think the advice is, don't completely avoid selling, but this is a case where maybe they nibble it down, but don't get carried away. We sold these 8 positions on the same day. Maybe in that situation, you just very methodically and, like I said, nibble to try to bring that back into some realm of, because let's face it, if something were to go wrong with Apple tomorrow that was cataclysmic and it's 50% of your portfolio, that's just not going to be pleasant. And it's not a zero probability.
Yeah, the words slowly and methodically are ringing in my ears from New Orleans, and especially when we were talking to that particular club that held that huge position in Apple. But I counsel any group out there that whatever you do, do it slowly and methodically, and do it with reason. Demand that there be reasons for what you're going to do, not just feelings, but reasons. When you do that, I think it slows the process down and it makes people think a little bit. And a lot of times I think it improves decision making.
Absolutely. So with that, maybe we'll come back and talk a little bit more detail about that type of an overweighted position in a portfolio in the future. It's a topic that many are tackling. And with that, anything else in the hopper, sir?
No, nothing else in the hopper. We're going to get our roundtable dates onto a chart, and we'll start promoting those dates because we're in a strange part of the calendar where a lot of the last Mondays and last Tuesdays of the month are holidays. So we're going to be moving some of our roundtables from the traditional last Tuesday of the month, and we'll try to give you a heads up a couple months in advance so you can put it on your calendar. I think also with our announcement for the December roundtable, I'm going to ask Natalie to give you the dates 3 or 4 months in the future so you can put them on a calendar and be aware of when they're going to be. Meanwhile, Tuesday afternoons at 2 still maintain the bull sessions. Maybe we'll skip one every now and then around the holidays, but we're not going to skip many of them.
Good stuff. Yeah, and the next, the December roundtable, I think, is on the 20. Oh, there I go. The November roundtable, what day is it, Ken? It's
The November roundtable is the
28th.
Tuesday after Thanksgiving, and it's the 28th, right?
okay. All right. Thank you, sir.
Thank you, Mark.
All right. Take
Thank you,
care.
everybody.